Hello everyone and welcome to today's market snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now it's been quite an eventful 24 hours. I think it's safe to say the biggest event of the last 24 hours has been the Fed meeting. We got the rate hike that markets had almost fully priced in. But what shook the markets, or not shook the markets, but what moved the markets, I should say, and the reason why we've seen the dollar strengthen quite considerably since isn't the rate hike itself. The reason why we've seen the dollar strengthen is because of the Fed's forecast. The Fed expects 3 rate hikes next year, which was higher than what the markets were expecting, which was 2. The markets actually priced in 1 by November next year, and 2 in total. So the Fed is clearly ahead of what the market expects or expected. I think what's very interesting is that whereas last year the Fed actually expected 4 rate hikes this year and the markets just dismissed this viewpoint, this year it looks as though the markets have bought into what the Fed said, and I think it's helped by the fact that most Fed officials haven't priced in into their forecasts the potential for fiscal stimulus from Donald Trump, just simply because they don't really know exactly what that would entail. So that leaves the door open to potentially an extra rate hike next year. And it's something that the markets clearly believe is possible, given the fact that we are seeing tighter markets, the fact that we are seeing rising oil prices, and then throw fiscal stimulus in on top of that, and all of this is rather inflationary, and we're not actually that far from target as it is. So the markets have bought into this more hawkish stance from the Federal Reserve, and it's what's prompted this rally in the dollar from above 106 against the euro down to 14-year lows, near 14-year lows, to around 104, where we have currently found support. But the important thing is here, we've not just broken through small short-term resistance. Like I say, we're now trading at a 14-year low, and we've taken out all of this support, which had been quite a solid area of support for quite a while now. You look at the first time we found support here around March of last year. You see it again in April, and then again we saw it in around December time, and then we were finding it around here as well back in November and December, and now we have broken through here. Now the difficult thing that we have now is that when we did break through this level, there wasn't any notable support just below here. So we may be looking at this situation where we're looking at around round figures. So 104 is where we've run into a little bit of support now, maybe 103.50, 103. But if you look below here now, I won't show you where we've got these levels from the chart because it's 14 years ago and it would take some time. But really, the next major zones of support here coming around the 101 to parity. So we've got some drop beneath us now potentially in euro dollar to look forward to. We may see some minor corrections along the way, but it would look as though at least we've entered into a new range. I guess we'll find out where the temporary range low is soon enough, but ultimately it looks like we could be looking back towards parity sooner than a lot of people thought. So an interesting breakout here in euro dollar. We also saw a break in cable, pound versus the dollar, that is. So we had resistance here around the 127.50s, 128s. Now there was a number of resistance points blocking the move higher here. We had this prior zone of support here from July and from August of this year. Prior support turned resistance. We also had this moving average band with the 55 and 89 moving average band offering some resistance as well. It was also the 61.8% retracement of the move from the September highs through to the October lows. That was rejected on a couple of occasions, and I had this trend line drawn on from previous videos, which we did actually break below yesterday, and you can see that the move below since has been quite relentless, falling from around 126 through to around 124, where we have found temporary support, but we are still trading at or around the day's lows, so this still looks quite bearish. The next notable area of support now comes in around these 123s. It's a prior zone of support. It's also the 38.2% retracement of that move, which may offer temporary support, but for me, I think we could be looking a little bit lower than this. I think if we break through 123, and then the next notable area is this one right here. You can see around the 121 levels, and you can see that we found support here on a number of occasions once we started to see that consolidation. So again, I think there is a bit more downside to come here. I'm not convinced we can necessarily break through these 116s that we hit during the pound flash crash, but at least in the short to medium term it looks like we are going to see a little bit more weakness to come in the sterling dollar pair. Let's take a look at dollar yen next, because again, these have been broadly dollar moves. We are seeing more gains in the dollar versus the yen. Now again, I've talked about this previously. The reason why we get the moves more so, it seems, in the dollar versus the yen rather than dollar versus other currencies is simply because of the Bank of Japan's monetary policy stance. The Bank of Japan has moved slightly away from guaranteeing X amount of purchases each month of Japanese bonds to maintaining the 10-year yield at or around 0%. And what this means is when you do see someone like the Federal Reserve raising interest rate expectations in the markets, talking about higher levels of inflation, then the markets are obviously going to adjust. And we've seen the 10-year yield on US Treasuries actually rising now. I've got it just here to see where we are. We're at 2.62% currently, which is higher than we were trading at clearly prior to the Fed event. And this is typically therefore going to lead the dollar yen higher because the yield differential between US 10-year and the Japanese 10-year is widening, and that what sends this higher. So you've seen a strong rally in dollar yen off of these 115 lows to trade at around 118. We've broken through the top end of that channel, which I think is interesting and just goes to show how bullish this actually is. But we've also broken that 61.8% retracement as well. We've run into some resistance, like I say, around these 118s. Now that 118 is a level I highlighted previously, because if we just scroll a little bit back here, you can see that this was an important zone of support really from February of 2015 through to the end of the year pretty much, and it looks like we're now finding resistance around these levels again, but this is looking quite bullish right now, and it's obviously not going to be a straight line higher, but if we see this level broken, then I think we are looking at these 120s potentially looking up towards 120 and then 120, 150, so things looking quite bullish once again in the dollar versus the yen. Let's look at sterling yen. It's also been a sterling day. We've had the Bank of England announcement today. It's worth noting that there was no change in monetary policy from the Bank of England. No talk of cutting or raising interest rates. But we did obviously get the minutes from the actual meeting itself. The votes, of course, were unanimous, and I think that's an important thing to point out. The Bank of England clearly has no desire to be changing monetary policy in the near term, and all people are on board, all officials are on board with regards to that. But there were some interesting points to come from this, from the minutes. The Bank of England did reiterate the fact that there is limits to the extent that above target inflation will be tolerated. This is something that they had mentioned previously, but they did note that the rise in the pound over the last month points to less of an overshoot than anticipated in November, and there's kind of this mixed message I guess you get from that. The one thing is the fact that they're continuously reiterating this point that above this overshoot won't be tolerated, will only be tolerated to a certain extent, suggests that they are potentially considering the fact that they may have to raise interest rates if inflation does continue to pick up at the pace we have been seeing and the pace that they are expecting. But the fact that they are obviously then trying to keep markets calm on the matter in saying that the sterling rise points to less of an overshoot suggests that while this is something that they may be faced with, the signs are there that they may not have to actually act, at least not in the coming months. So that was one interesting point to come here. The other part was the fact that it sees Q4 GDP at 0.4% and inflation rising to 2% within 6 months. That's a very short time period, so we may be faced, say, before the end of next year with the possibility that if inflation does pick up faster than the Bank of England expects, then we could be potentially looking at the possibility of a rate hike, and that really does fall in line with what we've been hearing from people recently, that the next move in UK interest rates may be more likely to be higher now rather than lower. Now, in terms of what this means for the chart, we have seen the pound move higher against the Japanese yen. I think this is a combination of yen weakness off the back of the dollar move and pound strength, but the important point is we've moved through this area of resistance around these 146 levels. We've moved through the 200 and 233 day simple moving average band, and while we have seen it pair some of these gains around the 148s, we are continuing higher in this channel, and really the next major area of resistance comes in around these 152s to 153s. We may see some temporary profit taking in the short term, but things are looking a lot more bullish now. What I am looking for though is keeping an eye on this lower part of the channel, because just because we may be headed towards these 152, 153s, as always with the markets and with trading, it's a case of timing. We may be headed that way, but it doesn't mean we can't see a correction in the short term, and given the strength of the rally we've had until now, that wouldn't come as too big a surprise. The fact that we have seen a new high being made, but we've seen it pairing these gains quite shortly after, would potentially indicate that a correction is on the way, and I think a break of that rising channel would at least suggest to me that we may see a correction in the we may see a correction in the near term, rather than have to wait a little bit longer. You can see the last couple of highs have been made on falling momentum, as you can see on the MACD histogram and the MACD moving averages at the bottom here. So I'll be looking out for a break below this channel, at which point I think the key test on this 4-hour chart will be that moving average band and the Ichimoku cloud as well, and that comes in around these 143 to 144. So a few levels to be keeping an eye on right just there. While we're on the yen, let's take a look at the euro yen. And I'm just going to stretch this out so we can get a bit more view of the moving average bands. Anyone who can't see the full moving average bands, you just scroll out and it will just get more data, and then you get a bit clearer picture. Euro rallied against the yen also on the back of that Fed move, and we did run into resistance around these 124s. Again, this is a level we've highlighted previously, prior areas of resistance, but also here you've got the 38.2% retracement of the entire move from the highs back in 2014 through to the lows of this year. So that could be quite an important level of resistance, especially if, like the sterling yen pair, it looks as though we might be looking at a potential correction of some kind in this pair. So we've run into resistance around this level, and we have pulled away from there currently, potentially signalling that we're going to see some form of correction here. Let's look back at the dollar. We've done sterling yen. There's two more currency pairs which I wanted to touch on here. One is the Australian dollar versus the US dollar. That US dollar strength really has played through here. We did see a move lower. We saw this consolidation, this rising wedge, and we did see a move to the downside, which is what you'd typically expect from a textbook rising wedge move. We saw a break through the 74.50s, which took out the rising trend line, the support level of the wedge, and then we have seen this continue low. We've seen quite a strong move lower here in the Australian US dollar pair. Currently trading around the 73.50s, but really ultimately I think we could be looking around 73 here. This is the most recent low, and this is an important zone of support now for the Australian US dollar pair. Final currency pair is dollar CAD, and it's interesting again. Let's just move out and just see these moving averages fully form here. Let's get some more data, as I've just mentioned previously. But it's interesting to see here, right? We've had this move lower in dollar CAD. We've had this rising channel ever since, which comes from May of this year, and we've stayed pretty much entirely within this channel during that time. We've tested the bottom of the channel and the 200 and 233 day simple moving average band, and from here we've propelled higher following the release of that Fed statement. Now we're trading at around these 134s. That's a prior zone of support, which is why we're potentially seeing some resistance here. Let's try a fib retracement on there just to see if it's an important fib level also. So you can see this is a 61.8% fib retracement level as well, so that's going to be an important test I think for this pair. If we see this rotate downwards off here, and we could see this the bottom of this channel coming under pressure once again around the 130, 150s. For now we are finding resistance around this level, but a break above on the other hand would be quite bullish, and it would suggest that we're potentially looking at a move back towards these 135.50, 136 levels, and maybe even the upper part of the channel. But again, if we do see a move high, then we've got that 50 fib to contend with, which could be a potential important area of resistance once again. While we're on the dollar, let's just have a quick look at gold now. Again, I'm just going to scroll out, get more data. And again, sometimes you may see that your analysis has moved from the chart, but again, just scroll out and it will catch this again. And look at that, we've seen a breakthrough 1150. That 1150 1200 range didn't hold for too long. We've seen a break through that 1150 now, which could open up a move back towards these $1,100 levels. Now you can see the last time we were trading around these levels, that we had support and resistance just around these 2 points. Let me just get this on, make sure it's accurate. So you're looking here, this was around 1110, was proved to be a notable support previously. I am also going to add 1100 because you do quite often see 1100, 1150 and so on and so forth prove to be important support and resistance levels here for gold. So I'm just going to add 1100 as well, just to make it a noteworthy potential support level. But it looks like we may be hitting that level sooner than you think. So this 1100, 1110 level. We're also approaching the bottom of this descending channel, which we've been trading in as well. So you may see a little bit of profit taking potentially around these 1125. So another level worth keeping an eye on. But things once again certainly looking bearish for gold, which shouldn't come as a surprise. When the Fed raises interest rates and raises interest rate expectations and inflation expectations, that is typically bearish for gold. Stronger dollar is typically bearish for gold. And if gold is an inflation hedge, then when we see that the Fed's potentially looking to raise interest rates and rein in inflation, and then again bearish for gold. The last thing I want to highlight is the Dow, because it looks as though we're going to see that 20,000, that psychological's 20,000 level coming under pressure once again today. We saw a little bit of pairing of the most recent gains following the Fed decision, but they were very small moves, which shows that the market wasn't freaked out like it may have been at times in the past. Clearly the market is now looking at these rate hikes as a positive thing, because we're seeing the economy improve, we're seeing unemployment fall, and we've got the potential for fiscal stimulus under the Donald Trump administration. These are all bullish for equity markets, and clearly the markets and investors now believe that the US economy can actually withstand this faster pace of rate hikes, which is how the market should be functioning. So this 20,000 level now is key. If we see a breakthrough there, then we could see this we could see the Dow once again being propelled higher. And as I've highlighted in previous videos, we've got these channels on to potentially show notable levels, because ultimately we're trading at record highs. Where do you look for potential resistance and profit taking? Now we may take a little bit longer to get here yet, but these 20,650, 20,700 levels could be key, with it being the top end of this long-standing channel. I'm just going to double click on this right hand side so the chart readjusts. We've got this long-standing channel here. I've added two on, one wider than the other, but the top part of the channel does seem to converge around this 20,650, 20,700 level. So that could be where we're headed for the Dow. But the first thing we've got to take out here is that psychologically important 20,000 level. As always, guys, I hope you found that useful. Please do add any comments you've got below the box, anything you want me to talk about more, and any feedback is as always greatly appreciated. For more in-depth news and analysis, check out OANDA MarketPulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.